What issues should I consider during a recession or market correction? Let's break it down on this episode of the Hawaii Retirement Show. All right, welcome everyone. Thanks for tuning in to this episode of the Hawaii Retirement Show. Today's episode, we're talking what issues to consider during a correction or a recession. Okay, and I want to start off this episode more so than most of the episodes. This is not investment advice. It's not investment, legal, tax advice on this show. I'm just simply outlining some opinions and some historical context, some academic facts and things to consider here. I don't want to get into politics here or making predictions about the tariffs and the impact they're going to have. I'm just kind of talking about the stock market more broadly. Definitely interesting times here. Time will tell how bad this is, or if it turns out to be just a blip on the map there. But market corrections are anytime the market dips 10% or more, right? And the point I want to get across here is this is more common than people think, in that historically it happens once every 1 to 2 years. So it's not uncommon to have market corrections, right? Things aren't steady state in the market. The markets are driven by fear, greed, speculation, and then the underlying value of the asset you're buying, right? So there's a lot of factors involved. There's geopolitical factors, there's inflationary factors, all kinds of things that go into this. And so it's never just going to be a steady, a slow increase up to the right? There's always going to be ups and downs. And a market correction is if it's 10% or more, that's considered a market correction, and it happens every 1 to 2 years. Not necessarily a bad thing. A lot of things in the business cycle go up and down, right? There is always expansion and contraction. And not every correction needs to turn into a recession, right? It doesn't really happen that way. A lot of times, most times, there's corrections with no recession. A recession is possible, however, but a recession happens about once every 6 to 7 years. Okay, so correction once every 1 to 2 years, a recession once every 6 to 7 years, which isn't as frequent, but it's still pretty frequent, right? Once a decade, you're going to have a recession, more or less, right? Typically, the average length of recession is about 11 months. What they call the Great Recession, which is the 2008 one. It went from December 2007 to June 2009. That was 18 months of length of time during that recession. But, on average, about 11 months, so about a year, right? So every 10 years, every 6 to 7 years, right, we'll have a recession. Once every decade, I would say. And it'll last about 11 months, and you'll have that downturn. Times will get tough, market will be down. I think the point I wanted to drive across with this is these things happen. And as much as we want a smooth, calm seas out there, COVID's going to happen. 2008's going to happen. The tariff thing now, it's going to happen. Nobody can predict it. A lot of people will come out after the fact and say, I saw this coming. But these things happen, and the market takes a dip, and it bounces back. In a lot of ways, it has to. The economic system that we've developed here is predicated upon, market sustainability. Everybody's pension is invested in the market. Everybody's 401k is invested in the market. Even for those out there who say, well, I got an annuity, and I take the risk off my plate. Yeah, but that life insurance company or that insurance company that sold you the annuity, they're invested in the market. And if the market completely crashes, then they become insolvent and they can, they go out of business. You no longer get your annuity. You know what I mean? So the market has to succeed. Otherwise, we're back to some crazy times there. So these things will happen, and they'll always be the next apocalypse du jour, right? What's coming next? The sky is always falling with what's next. A lot of people sell fear. And if you predict a downturn and catastrophe enough, eventually you're going to be right? Because there is always going to be something that drives this. One thing you'll hear is, well, this time's different. And maybe, because even that, if you say this time is different enough, eventually you might be right. But probably not, right? This is probably another, whatever it might be, just another market correction. Or maybe it goes further and becomes a recession, right? Then it's just another recession once every 6 to 7 years. I think if you ask 10 economists, you'll get 12 different answers. Okay, because no one knows. Has anybody, listening or myself done deep dives into the weeds of pages and pages of impact of geopolitical global trade and the intricacies people spend their careers, highly prestigious institutions studying this stuff and still get it wrong. So I don't want to come on here and give any predictions or act like I have any clue of what's to come here. But I say there's good news to all of this in that your money should be invested with all this in mind. Your money should be invested knowing, this is going to happen. And I like to say, I always say this, and I didn't come up with this. I don't know who did, but I've heard it. Each dollar has a use by date, and it should be invested appropriately. If you needed money in 2025 for use in 2025 for whatever reason, those dollars, shouldn't be invested in a way where it's subject to high volatility and high risk and now unable to be used in 2025. There's ways of reducing the risk for the money you need in a certain time period. And you do that through bonds, corporate bonds, municipal bonds, U.S. Treasuries, CDs, brokered CDs, MYGAs, multi-year guaranteed annuities, buffered ETFs. There's all kinds of ways that you can position assets so they're not exposed to the market volatility in a time when you need them. Now, this is most important for those nearing or in retirement, because that's usually when you need your invested dollars. For those in their 20s and 30s and 40s, this will ultimately probably end up just to be a blip on the map, and you just keep dollar cost averaging, and this won't even affect you down the road. But for those in retirement, or if you needed the money that you had invested at this time and you weren't positioned correctly, then yeah, this could set you back, right? The other aspect of this, other than the market going up and down, is inflation. Inflation plays a big role because it's purchasing power. If the market goes up but inflation goes up, then it's kind of like swimming upstream, right? You're kind of fighting a current there. And so inflation also plays a big role in this too. I don't know what inflation will do. I would expect, with these tariffs, it's going to go up or possibly, remain at the same levels for a good long period of time here. But again, ask 10 economists, you'll get 12 different answers. We don't know what the Fed is going to do. And as long as you just understand that there's all this uncertainty, you can create a plan around it, right? You can position yourself to tackle this head on. There's a little checklist here that I have. What issues should I consider during a recession or market correction? It'll be up on the YouTube for those watching. I'll send a link to it in the show notes, and it's up on the Hawaii Retirement Show website. And it's just a couple things I just want to go through real quickly here, starting off with cash flows. Okay, in a recession or market correction, will your cash flows be tight, right? So you might have to reduce spending. Obvious stuff here. Do you need to review or increase your emergency fund? It's a good time when times are good. We can get a little bit loose with emergency funds or get a little aggressive with our investments, and it's only when things turn south that we start to look at, I probably should have a little more in my emergency fund, or I kind of let that drop a little bit, right? So take a look at that. Again, the retirement thing, that's the big one. If you look to retire in the near future, the next couple of years, there's definitely some Hopefully you were positioned in a way for that all along, but there's some things to consider there. Taking distributions from investment or retirement accounts, that kind of goes into the tax planning side of things with like conversions is one way to look at this. I'm sure everybody's heard the term buy the dip, right? Meaning you buy low, right? When things like this happen. But another thing you can do is if you have a mixture of pre-tax and post-tax assets, right? Traditional and Roth in retirement accounts, 401ks, TSPs, IRAs, during a market drop, it can sometimes be a good move to do a conversion, pay the taxes, take it from a pre-tax traditional side and over to the Roth side. And essentially what you're doing that is at a low point, and now as it grows, you got to convert money at a lower amount as opposed to converting it when it's high and you're converting at a higher amount. So conversions are another way to sort of buy the dip, or you can take distributions from those in market downturns. If you got to take distributions, you could take it from your traditional pre-tax accounts, and that way you're kind of pulling money from your account from the and paying the least amount of taxes by taking the down market pre-tax money out. Rebalancing your investments in retirement accounts. Everybody should have a strategy for doing this, and whether that's once a year, twice a year, quarterly, whatever it is, right? You have a target allocation of how you want your money invested, and periodically you tune back in and you rebalance. And during market downturns, that doesn't really change. There's some people who will say let it ride, right, where you're going to let the equities recover, and that's fine. I'm not arguing against that, but I think the best way to approach a lot of this stuff and the uncertainty is have a plan of dollar cost average. I invest this much every month, regardless of what the market's doing. This is how I want to be positioned, and I rebalance this, this way, regardless of what the market is doing. I rebalance when it's high, I rebalance when it's low, and this is my target allocation. It doesn't have to be so stringent and as that, and I'm not arguing against if you have the luxury of waiting for all your equities to recover. That's fine, especially in those younger years. What else do we have here on this checklist here? Let's see. I mean, there's some estate planning considerations. What is she? I mean, it's just it's all the same stuff. But check out the checklist for yourself. I don't want to read through each one of these here. You can download it on the website. Touching on estate planning, I was just talking with somebody here who's an estate planning attorney that I hope to have on in a couple weeks here, and we'll talk some trust, wills, power of attorney, some general estate planning stuff. So if there's anything you want me to ask in particular to this estate planner who's going to come on the show, email it over to aloha@hawaiiretirementshow.com. And I think that wraps it up here. We'll catch everyone on the next one.
The opinions and statements presented on this show are for general information only and are not intended to provide specific advice or recommendations. Never make any investment or financial decisions based on information offered on this show without first consulting your financial, legal, or tax advisor. All economic and performance information mentioned on the show is historical in nature and is not indicative of any future results. All indices mentioned on this show are unmanaged and cannot be invested in directly. All information is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. Lastly, all opinions expressed by Jason Cutitta and any guests on the show are solely their own opinions and do not reflect the opinions of or are endorsed by ToBA Financial. For Jason Cutitta, investment advisory services are offered through ToBA Financial LLC, a registered investment advisor offering advisory services in the state of Hawaii and in other jurisdictions where exempt from registration.